Looking for more expert investing advice? You should check out the Experts and Analysts page on SmallCapPower.com. And while you're there, be sure to check the Experts and Analysts Top 20 Picks. It's under the Premium Research tab. Happy investing from your friends at SmallCapPower.
The SmallCapPower Expert Interview.
Welcome, Robert. Can you please tell us about your firm and your role there?
I work at 1832 Asset Management LP. 1832 Asset Management is the advisor for both the Dynamic Funds and Scotia Funds. We are wholly owned by Bank of Nova Scotia, and my role there is the mining specialist. So I have a background in mining and mineral process engineering. I have an MBA, CFA, and I've actually been working at the company now for 16 years.
Can you tell us your outlook for gold and silver during the next 1 to 2 years?
Over the next 1 to 2 years, we're fairly constructive on gold and silver. So, we'll talk about gold first, and we have really a perfect storm for gold. Basically, gold will do well when people are fearful of the expansion of global liquidity. That's probably going to be necessary in both Europe and the US to sustain the economy. I think what we are seeing is, while we are seeing some monetary policy easing, it's kind of simplistically, it's like taking a training wheels off of a bicycle for a young child, but the child's still not ready to go off the training wheels. So I think we're experimenting with taking them off, but I don't think it holds for very long. I think, therefore, under that scenario, it is constructive for a monetary asset such as gold, because basically what people are always programmed into thinking is, what is the gold price in dollars per ounce? The proper way to think about the gold price is actually the reciprocal, ounces per dollar. So in a way, gold doesn't do anything, it's what currency is going to do. So if you think about what the purchasing power of a currency is, either gaining power or losing power. We have probably more reasons to see it over the next few years lose power, but just modestly. And you'll have more purchasing power protection in a hard asset such as gold. Silver is a little bit of a different story, but still somewhat the same story. Silver is also a quasi-monetary asset insofar that it has been used in coinage, but it's not accepted as a reserve asset by central banks around the world. Nonetheless, in a normalized economic environment, we will see the gold to silver ratio emerge at its around above or below its 40-year average of about 55 ounces of silver per ounce of gold. If it's a little higher than that, then it means that things are not on as solid a footing as one would hope. If it's lower than 55, then things are probably a bit more on the euphoric side of things. So right now, with the silver to gold or gold to silver ratio at 65 to 1, it's telling you that we're on a fairly solid footing, but there's still room for the footing to improve till we classify it as a normal situation.
Do you think the gold equities will outperform the gold price this year?
Well, in a upward gold price environment, gold equities will outperform. And the corollary is true. If gold price drops, you're more defensive in the physical metal than the equities. The simplistic way of looking at that is you're looking at most gold companies have roughly a 20, maybe a 30% profit margin. If gold price goes up, let's say gold price were to move up suddenly $100 an ounce. Typically, you're going to see other things move up in tandem with that. You might see the oil price move up. Eventually, within 2 or 3 quarters, chemical prices. A big component for the industry is labor. So labor prices can be sticky on the upside. So insofar the time lag in which they're sticky, it works out to being profit margin. So when the excess profit margin in an absolute term grows, on a relative term, on the percentage, that obviously grows too. Over time, that percent margin will start to shrink, but nonetheless the absolute margin will be obviously greater. Obviously your profit margin, if you're making, say if you made a constant 20% margin, It's twice as much money at $2,000 gold as it is at $1,000 gold, yet it's a 20% margin. The corollary is also true on the downside. If gold prices fall like we saw them last year, you'll see other things eventually working through the system. You will see mining equipment prices fall, chemical prices fall, steel prices fall, because the factors that move up the gold price are the same factors that would push up, say, the oil price or other commodities. So all in all, you got to look at the industry as fairly stable. People think that gold price is a very spurious thing, and it really isn't. It's really tied into the entire world and foreign currency as well. So when you're looking at what's going on with, I always say if you can understand global currencies, you can understand the world. And so that ties into gold, because gold is basically a cornerstone monetary asset.
Can you tell our viewers which resource stocks you like at this time?
In a fairly stable environment that we're in, I like to typically barbell the portfolio. While I don't have huge aspirations for the gold price, as I say, might constructively move up about $100 an ounce over the next year. Part of me wants to be conservative. I want to offer our unit holders a very optimal risk to reward ratio. So we will own some big cap companies. Like one would be Randgold Resources. This is one of the premier gold producers in the world. It's both London and US listed, dual listed stock. Maybe not necessarily a household name, but certainly one which has had an impressive growth profile and very good management track record. Gold Corp would be another one as a cornerstone holding. We also own other senior companies such as Franco-Nevada, which is the premier gold royalty company, Fresnillo, which is the largest primary silver producer in the world, that in a single asset or commodity focused company. But then on the other hand, in a rising environment, we also prefer to look out for our best development companies that we can find. So while I won't own a huge dearth of development companies, I'll be extremely focused and pick, say, my 5 or 6 favorite in the world and own those in size. Things that we've done in the past where we are the first movers into names that later become household names. For example, like Osisko Mining, we're the first institutional shareholder there. I think we bought shares at the beginning when it was 30 cents a share. We were the largest shareholder of that company, and today it's under a variety of takeover bid war, I guess, between Gold Corp and then recently Yamana trumping it. And probably by the time people watch this, there'll probably be another chapter that may have opened up in terms of that bid. But it was certainly not anything near a household name. So what I'd like to do is pick the, my top development stories in the world. I straddle looking at the Australian markets, the London market, the Toronto market for the best opportunities in the world. So things that we've uncovered are things like Papillon Resources out of Australia, which has a multi-million ounce discovery, high grade, very robust economics in southwestern Mali. Another one is on the Canadian exchange is Roxgold. It's about a $125 million market cap company, but they have a significant high-grade discovery in Burkina Faso. It's about 1 million ounces of gold, around half an ounce per ton. So not the largest of mines. It will produce about 100,000 ounces a year, but the internal rate of return on these projects is north of 35-40%. So it doesn't really matter what you're doing in this world. If you're able to find a project then that can generate those kinds of yields, certainly worth owning.
Keep up to date with all of your favorite small caps. Subscribe to our free newsletter and get daily investment ideas, breakout stocks, momentum gainers, expert and analyst stock picks, and more. SmallCapPower.com, investing ideas and research.